Welcome to Capital Allocation Lab, the audio-first channel for long-horizon investors.
Our mission is to teach disciplined, long-term investing by revisiting classic ideas and translating them into today's decisions.
If you find this useful, subscribe and like. Your support keeps these lessons free.
Today, we're undertaking a deep dive into, well, one of the most effective tools a long-term investor can possess: comparative analysis.
Yeah, we're unpacking a guided tour through 8 pairs of companies. The kind that often sit right next to each other on the stock list, but represent completely different financial realities. It's fascinating.
Absolutely. And the objective here is rigorous pattern recognition. We want to train your eye, really, to instantly spot the fingerprints of discipline versus, let's say, promotion.
And more importantly, understand how to translate price into value when you're making those real-world, long-horizon allocation decisions.
Exactly. This isn't some theoretical chat. It's more like a guided workshop, developing better judgment through structured, side-by-side observation.
And we'll keep the tone calm, educational throughout. The focus is entirely on internalizing these timeless patterns.
So let's start with why this pair method is so useful fundamentally. You look at any stock in isolation and, well, every single one has a compelling narrative, right?
Oh, absolutely. Especially if it's popular with the market at that moment.
Right. But comparing two firms, say two neighbors on the stock list, maybe two packaging companies or two regional banks, that forces you to strip away the branding, the slick IR storytelling, the sheer momentum of popularity.
I think that stripping away the narrative, that's probably the most powerful part. It acts as an immediate antidote to one of the biggest biases we have, mistaking, rapid growth or just being popular for true safety.
Exactly. But the moment you put that 30 times earnings company right next to a peer, maybe one in the same industry, same environment, but trading at, say, 15 times earnings, the whole conversation shifts.
It really does.
The emotional justification just kind of evaporates. It's replaced by this stark, disciplined question. Okay, what exactly am I getting per dollar of tangible capital, real assets, and verified earnings here versus there?
Yeah.
And that contrast, it demands objectivity. It disciplines the mind against getting sucked into the narrative or, that fear of missing out.
And that disciplined contrast, if you apply it again and again, it trains 3 specific habits.
Yeah.
Really invaluable habits for anyone allocating capital long term.
Okay, what's the first one?
First, you anchor your analysis on the core economics before you even listen to management's story.
Right, cash first.
Exactly. How much cash truly flows in? How much capital is tied up just keeping the lights on maintenance capex? And critically, how much structural risk, especially debt and hidden leverage, sits ahead of your equity claim? You prioritize cash and capital commitment above everything else.
That makes sense. And the second habit?
The second, which we'll definitely dig into more later, is decoding the capital structure. Too many people just stop at the common stock list.
Very true.
The comparative method forces you to look deeper. Find every potential claim: convertibles, warrants, weird preferred stocks, complex debt. You have to understand the crucial difference between accounting equity, the simple book value, and the real claim you have on assets and future cash flows after everyone else gets paid.
Okay, so economics first, then decode the structure. What's the third?
And the third habit. This one's maybe the hardest, especially with all the short-term noise. It's pricing the business like a long-term owner, not a trader flipping stocks.
That means really assessing the normalized earnings power, right? Not just next quarter's number.
Precisely. Assessing the actual sustainable earnings power and comparing it against the total multiple you're paying today, including those hidden claims. It forces you to translate that multiple into an expected future return, an owner's yield.
And then asking if the growth needed to justify that yield is actually realistic or if it's just heroic hope.
Exactly. Does it require a perfect, unbroken run of luck? If so, maybe pass.
Now, a quick caution as we jump into these 8 pairs. We're really focused on memorizing these recurring patterns, the fingerprints of prudence versus promotion. We're not trying to predict next quarter's earnings for these specific historical companies.
Right. The goal is pattern recognition.
Yeah. Our mission is to see the enduring signs of discipline versus drift so clearly that, almost instinctively when to lean in with enthusiasm because value is genuinely on sale.
And when to hold back with some deep skepticism because the price is just betting on luck.
Okay, so let's move through the 8 teaching pairs. Focus on the core lesson from each contrast, remember. Internalize the pattern, not the specific names.
And then at the end, we'll bring it all together with that simple, actionable pair hour checklist you can use tomorrow. All right, pair 1. This gives us a really powerful contrast within real estate. Two businesses, almost identical labels, but fundamentally different characters, different financial policies.
Okay, lay it out for us.
On one side, you had this quiet New England trust, management focused solely on plain, understandable, real assets. They aimed for moderate, sustainable growth, mostly funded by retained cash flow.
Solid foundation.
Yeah, durable dividends, clean balance sheet, simple debt, mostly just long-term mortgages. It was, frankly, a bit boring, stable, predictable.
Boring can be beautiful in investing, though. So what was the other side?
The other side was its neighbor.
Yeah.
The promotional roll-up. The contrast was just stark. This firm went for relentless, rapid growth assets and debt ballooning over just a few years.
Okay, red flag number one, perhaps?
Definitely. And crucially, they sprawled way beyond their core real estate expertise. They were buying racetracks, movie theaters, even literary agencies, launching cosmetics lines.
Yeah.
It was all over the place.
Wow. Sounds like management wanted headlines more than efficient operations.
It certainly looked that way. And that expansion, well, it wasn't funded by internal cash. It was capitalized by what you might call exotic securities.
Ah, the complex stuff.
Exactly. Multiple series of warrants, quirky preferreds, and debt structured in 6 different flavors. 6. It was a chaotic capital structure, seemingly designed to maximize leverage and hide the true cost, at least initially.
So the lesson here is pretty clear then.
I think so. The core investor lesson is paramount. A focused portfolio of ordinary, plainly financed properties run by actual capital stewards will almost always beat a colorful, sprawling conglomerate funded with confusing paper.
That promotional entity might look great for a while, ride high on enthusiasm.
But that exuberance is fragile. It often masks weakness until the economy turns. That roll-up, built with thin interest coverage relying on perpetual growth to service its complicated debt.
So when a bad year hits.
Exactly. The thin coverage is exposed, and the whole structure can tremble or just collapse. The quiet trust, though, it can keep servicing its manageable debt, keep reinvesting right through the cycle.
So this pair teaches us to scan for specific red flags when we see rapid asset growth, right?
Definitely. 3 critical ones. First, look for multiple kinds of debt, especially with short maturities, short leashes. That signals high refinancing risk.
Okay, what else?
Second, be really aggressive watching for options or warrants. Those things are almost guaranteed to lead to future dilution, shrinking your slice of the pie.
Makes sense. And the third?
And third, be deeply skeptical if the market value is way, way above tangible book value, especially for a business without strong, durable economics like switching costs or real competitive advantages.
Real estate especially often being a commodity business. Paying 10 times tangible book, you're betting on management genius, not the assets themselves.
Precisely. And if all 3 of those red flags are waving, you absolutely must slow down your analysis. Remember, promotion often masks fragility. That exciting story sounds great until the cycle tests it.
And that excitement itself is a risk to your capital.
Absolutely. And a practical tip here. Read the auditor's language carefully. Conservative structures, like the quiet trust, rarely trigger dramatic auditor disputes or going concern warnings.
But the promotional ones.
They often do. Those emphasis of matter paragraphs pop up because aggressive accounting is needed to keep the growth story smooth. Avoid write-downs. Calm investors earn good returns by avoiding that kind of drama.
Okay, pair 2 shifts gears a bit. We move from capital structure complexity to valuation. We're looking at 2 industrial gas firms.
Same basic business, right?
Essentially, yes. One has better growth stats, maybe slightly tighter margins, and definitely a glowing reputation, the quality name.
And the other.
The other is more mundane. Trades at a deep discount, often overlooked by the big brokers. The market consistently pays a premium for the better name.
But the key question for a long-term investor is that premium justified? Does the higher yield from the cheaper name compensate for maybe slightly less stellar operations?
Let's put some owner's math on that immediately. The quality name, let's say it trades around 16 to 17 times earnings.
Okay.
While its plainer neighbor trades at just 9 times earnings. Same basic product, similar cyclical exposure, but the enthusiasm baked into the quality name's price is nearly double.
Wow. And if we flip that into an owner's yield?
The difference becomes really stark. 16 times earnings is roughly a 6.25% pre-growth yield. 9 times earnings, that's a much higher starting point, around 11%.
Big difference.
Huge. Now, let's assume both can grow actual earnings per share at, say, a modest 5% rate. The 11% base yield plus 5% growth gets you to 16%. The 6.25% base yield plus 5% growth only gets you to 11.25%.
So the cheaper one easily wins on total return, even with the same growth rate.
And importantly, that happens without needing any heroic growth assumptions. And critically, without needing any further multiple expansion for the cheaper stock. It just needs to keep delivering.
But let me push back a little here, because this is where market psychology bites. Doesn't that quality name at 16x maybe deserve the premium because it's more resilient? What if there's a bad downturn?
That's a fair challenge.
If the 9x stock drops 50% because it's seen as lower quality, and the 16x stock only drops 30%, didn't the quality stock actually offer better safety?
It's a crucial counterpoint, and it brings us right back to the arithmetic of expectations. Yes, the 16x stock might drop less percentage-wise, but remember, it started with so much less embedded yield.
Oh,
And when the cycle inevitably turns, that lower expectation stock, the 9x one, it has far less altitude to lose on the way down and has much more room for its multiple to re-rate upwards in the recovery.
harnessing mean reversion.
That's the essence of it. The plainer name starting at 9x might rally to 13x or 14x just by proving it survived. The 16x name might only get back to 17x. The percentage gain on the cheaper name is often way higher, even if its margins aren't quite as fat. So the discipline required here is that separation we talked about earlier. You have to separate your admiration for the business, its growth, its margins, from your acceptance of the price tag.
Exactly. If you decide to go with the better company, you have to rigorously demand hard evidence, not just warm feelings, to justify chasing that high premium.
And that evidence needs to be structural, right? Not just temporary.
Yes. Durable cost advantages, real switching costs, protecting margins, regulatory moats, something that fundamentally stops the cheaper competitor from ever really catching up. If the difference is just, 1/4 faster growth, that premium is probably too dangerous.
So the preference should generally be for the quantity of value, the lower multiple over quality at any price.
That's the takeaway. And as a final point on this pair, if you diversify across several decisions like this value versus quality premium, the base rates of return tend to favor the patient, value-anchored approach over time. You benefit from mean reversion and that higher starting yield, which gives you instant compounding power, regardless of market fads. Okay, pair 3. This one tackles a really subtle but potentially lethal risk: excessive goodwill, especially in stable, predictable industries.
Right. We're looking at two companies here in profitable healthcare adjacencies. Think things like medical supplies, maybe low-tech diagnostic parts, aspirin production, steady stuff.
Both stable, both profitable, but their stock prices imply these almost fantastical levels of goodwill, sometimes billions beyond the tangible assets needed to actually run the business.
And the core issue there is the fragility that gets loaded onto the equity holder, isn't it?
Exactly. If you buy a business where the market price assumes decades of absolute flawlessness, all bundled into that intangible line item called goodwill, even a small, temporary slip in earnings can violently destroy a huge chunk of that implied value, and fast.
Let's try to visualize that gap with some specific conceptual numbers from the source material. Say a company has a tangible book value around $6 per share.
Okay, $6 in hard assets per share.
But the stock is trading at $70 per share.
Wow. So $64 of that price is just air, pure goodwill.
Essentially, yes. That $64 represents the market's incredibly optimistic belief that this franchise will deliver superior, sustained returns way out into the future, justifying that massive premium over the hard assets.
And let's say that company earns about $2.30 per share. That puts the multiple at 30 times earnings.
Right. So the valuation is screaming the same message. You are paying years and years in advance for sustained top-tier performance.
But here's the crucial analytical step people miss. What's the mechanism of fragility? How does this go wrong?
A small slip, just a single-digit percentage drop in profit margin, maybe some new competitive pressure that can easily trigger an accounting event called an impairment charge.
Right, the goodwill impairment.
And that charge is basically accounting catching up with reality. It recognizes that the previously recorded goodwill, that optimistic $64, isn't justified anymore by the updated future cash flow projections.
It's non-cash, but it rips a huge hole in reported equity.
And fundamentally shocks investor confidence. it can evaporate years of that priced-in goodwill almost overnight. It's a mechanism that quickly corrects over-optimistic pricing.
And this danger seems much worse in stable, mature industries, doesn't it?
Oh, absolutely. In hypergrowth tech, maybe you can sometimes justify huge goodwill gaps with breakthroughs and massive reinvestment. But in a steady business like medical disposables, the scope for wild operational surprises is small. You're not underwriting breakthroughs, you're underwriting persistence.
So when you see a price soaring way above tangible book in a stable sector, the prudent owner has to ask a tough question.
A heroic question, really. How many years of top-tier execution defined by actual cash flow or dividends would it take just to backfill this goodwill with tangible, usable assets?
And if the math looks like it needs a flawless run for, say, 15 or 20 years,
Then the price is inherently dangerous. You should probably pass.
is there a guardrail here? Something
Yeah.
to check?
Yeah, a good one is contrasting the return on equity, ROE, with the business's capital intensity. If the ROE looks stellar, mainly because the business is asset-light, relying heavily on marketing and branding, that quality is fragile.
Great when sentiment is high.
But unforgiving if confidence cools. Your job, really, is to structure your exposure so you can withstand a sudden, major impairment charge and the sentiment shift without risking your core capital.
Okay, pair 4 gives us a great contrast between, let's call it, market fashion and quiet durability.
All right, who are the contenders?
We pit a meteoric disruptor, think a high-flying tax prep firm, maybe sporting a triple-digit PE, almost zero tangible equity against a seasoned manufacturer, maybe a workwear or uniforms maker.
The mill versus the meteor.
Exactly. The mill has 5 decades of consistent dividends, steady margins, single-digit PE. But in the market's euphoric phase, the crowd's paying 100 times earnings for the shiny growth story and completely ignoring the boring old operator reliably churning out cash. This really defines the true owner's playbook, doesn't it? The high flyer, the meteor, might be a fantastic business operationally.
But if its market cap is, say, 30 times what you could liquidate the hard assets for, you're primarily buying sentiment. You're buying hope for future perfection, not current assets or discounted cash flow.
The underlying economics become almost secondary to the narrative, which introduces huge fragility.
Now, compare that to the mill, the apparel maker. Slow, maybe a bit cyclical, definitely not glamorous.
Right.
But every single year, its retained earnings and its consistent dividends systematically reduce your break-even holding period as an owner.
That compounding math.
Yeah, over any reasonable stretch, 5 years, 10 years, that consistent, tangible compounding math almost inevitably beats the narrative that required continuous miracles to work out.
The common trap here is investors asking, shouldn't I just buy the great growth?
Right. When the disciplined, correct question is, at what price does that growth actually belong to me, the owner, especially given this other option?
You have to explicitly write down the market cap, compare it to tangible book. Paying $30 for every $1 of hard equity. That's funding perfection.
Exactly. Conversely, if you pay, say, 1.4 times book and maybe 11 times earnings for a steady operator like the mill, even if it just performs adequately, you can still get satisfactory, market-beating returns.
Because the conservative starting price creates such a huge margin of safety.
Precisely. You don't need management to be heroes. They just need to stay competent.
But this requires a certain temperament, doesn't it? A willingness to look wrong for a while.
Oh, absolutely crucial for long horizon success. You must be completely comfortable potentially looking wrong in the short run. The meteors grab all the headlines, maybe hit new highs every day.
While the mills just quietly accumulate cash and, well, dust.
Your job isn't collecting headlines or chasing fashion. It's collecting excellent entry points at prices that don't require you to be a fortune teller. All right, our fifth pair highlights 2 complementary traps, sort of the twin dangers of overpaying for obvious quality and getting stuck in a value trap.
Okay, 2 ways to lose. Let's hear them.
On one side, we have a niche ingredients company, maybe making specialized flavors, that kind of thing. Superb margins, rapid growth, genuinely impressive operationally.
Sounds great. So what's the trap?
The trap was the price. It was valued at more than 10 times its book value and over 50 times current earnings.
Ouch. 50 times earnings.
Yeah. Operationally excellent, but the price just baked in absolute perfection forever. That made it a bad purchase, offering really negative asymmetry, lots of downside, limited upside from there.
Okay, so that's overpaying for quality. What was its neighbor?
Its neighbor was a legendary, established heavy equipment manufacturer. This firm consistently earned too little on its massive capital base and, as a result, often sold below book value. Superficially, it looked cheap.
The classic value trap setup.
Exactly. It needed a huge, expensive turnaround that unfortunately just never fully materialized. So the appearance of cheapness hid the ugly reality of inadequate returns on capital. It just tied up capital unproductively.
So this pair gives us two really essential enduring truths.
What are they?
First, a genuinely great business can still be a terrible purchase if you drastically overpay. Quality isn't some magic shield against bad pricing.
Right. And the second truth.
Second, a mediocre business can be a permanent value trap, even when it's trading below tangible book.
Why is that?
Because book value, if it's not generating enough earning power above the cost of capital, it's like unsellable inventory piling up. It's capital, technically, but it's unproductive, stuck, just wasting your time and opportunity cost.
So the wise investor has to resist both temptations, the siren song of quality at any price, and the false comfort of cheap just because it's below book.
Yeah, both roads can lead to misallocated capital and poor long-term returns.
So what's the actionable stance here? How do you navigate this?
It's discipline neutrality. You wait until price meets principle.
Meaning what, exactly?
Meaning you wait. If that high-quality compounder hits a market scare or has a temporary stumble, and its multiple drops back towards, say, the mid-teens, that's your window.
Okay. And for the asset-heavy giant below book?
You wait for proof it's actually earning its cost of capital, and not just paper profits. You want to see tangible actions, like aggressive share buybacks funded by real free cash flow. If they can retire shares while earning their cost of capital below book, that's your opportunity.
And to stay grounded, you need absolute tests, not just relative ones.
Definitely. Look at free cash flow yield. Look at returns on incremental capital. Track maintenance CapEx versus depreciation. Are they under-depreciating to flatter earnings? These anchors pull you back from seductive stories and false bargains. Okay, pair 6. This one's a stark reminder of what we can call category halo risk. It flares up dramatically during market peaks.
Right. The historical example here involved publishing stocks. The whole sector had this halo effect.
So what happened?
You had this celebrated publisher trading at an astonishing 35 to 40 times earnings.
Okay.
Earnings which were alarmingly shrinking, and the price was 8 times its tangible equity.
Wow. 40x shrinking earnings and 8x tangible book. That's something.
It is. And the market had completely ignored its industrial neighbor, a simple electrical equipment maker. Higher sales, stronger finances, much lower multiple. Just boring and ignored.
The danger here is timeless, isn't it? Enthusiasm for a trendy sector can just overwhelm basic analysis.
Completely. The story of new media just drowned out the math of the old industrial. But arithmetic always wins eventually. Paying 40 times for declining earnings, that guarantees zero margin of safety. Every quarter becomes a huge downside risk.
Whereas paying, say, 15 times for healthy, stable earnings, modest debt, ample working capital, it's not glamorous.
No, but it's what successful long-term owners do. They anchor to a reasonable return. They understand time is on their side.
And when optimism gets that far ahead of the math,
A reset is guaranteed. That publisher eventually crashed, falling from the $50 down to around $10. Massive permanent capital loss for those who bought high.
and the boring industrial.
It held up much better comparatively, and it recovered first when the cycle turned. The quote to internalize here is crucial. Hope can triumph over experience for a while, maybe a few quarters, but it cannot and will not triumph forever.
So what's the practical guardrail when a whole sector gets bid up like that?
2 simple objective things. First, pull a 5-year trend of earnings per share for the company you're looking at.
Yeah.
If that trend is flat or worse, declining while the multiple is soaring, that high multiple instantly deserves deep skepticism, not excuses. Declining earnings at a rising multiple is betting purely on hope.
Makes sense. What's the second check?
Second, compare the stock price to net tangible assets. If that ratio screams billion-dollar goodwill in a mature or challenged sector like publishing was then, you demand absolute operating proof now. Tangible free cash flow, not just promises or guidance.
And if the proof isn't there?
You step away. Get out of the emotional feedback loop of the mania. Okay, pair 7. This one is absolutely critical for understanding how complex capital structures can really destroy shareholder value through hidden costs and amplified risk.
All right, sounds important. Let's break it down.
We're looking at a showy conglomerate, let's call it the gadget firm. It carried layers and layers of debt, including convertibles. It had 3 distinct series of warrants. Multiple preferred stock tranches on top of that.
A real mess on the balance sheet.
A real mess. Now, the quoted earnings per share, the number on the surface for the common stock, it looked acceptable. It probably passed a lot of superficial screens.
But the true price? The all-in cost of owning that business was hidden.
Heavily masked by all those layers. So many investors, they look at warrants as just footnotes, right?
Yeah, easy to ignore.
But they are integral to the common equity package. If you actually treated the outstanding warrants as an unavoidable part of the package and added their market value to the common share price, well, the true cost per claim on the business more than doubled the headline figure.
Doubled, just by accounting for the warrants.
Easily. Now, contrast that complexity with its quieter counterpart, an appliance maker, maybe with simple government contracts.
That was its structure.
Beautifully simple. One single security outstanding. No net debt. And it reliably generated double-digit returns on equity.
Nice. And the valuation?
It routinely sold for a single-digit earnings multiple. Sometimes it even traded near its net current assets, just simple and cheap.
So what happened when the market tested them, say, in a downturn?
The outcome, specifically during the severe 1970 bear market, was entirely predictable. The showy, complicated conglomerate, it absolutely cratered.
Why?
Its complex capital structure relied on continuous growth and cheap credit. When those disappeared, the complexity brutally magnified the pain. Leverage cuts both ways.
In the simple appliance business.
It got cheap too, sure, but its clean balance sheet and lack of leverage preserved its options. It could weather the storm, it recovered much faster and with much greater force.
It really shows how capital structure is never neutral, does it?
Never. It either amplifies pain in downturns or it preserves essential strategic agility.
Okay, let's really slow down here and walk through that dilution math carefully. Using the specific numbers from the source material for that complex conglomerate, this is exactly how investors get lured into paying a phantom price because of tidy, quoted EPS numbers.
Good idea. This is crucial. So we'll use the conglomerate example. We're told it has 4.3 million common shares outstanding, trading at $44 per share.
Okay, 4.3 million shares at $44, doing the math. That gives a quoted common market cap of about $189 million.
Right, $189 million. That's the number you see on Bloomberg, on Google Finance, everywhere. That's the headline price.
And that price assumes no other claims matter, which we know isn't true here.
Precisely. Now, this company also had multiple layers of outstanding warrants and convertibles specifically, 3 series of warrants mentioned. These are essentially IOUs, right? Giving holders the right to buy future common equity, which dilutes existing shareholders like you.
Okay, so what were those warrants worth?
In the market at that time, those warrants traded for a combined market value of $221 million.
Wait, say that again? $221 million for the warrants.
That's right, $221 million.
Compared to a common equity price of $189 million. So the future dilution claims were worth more than the current common equity itself.
That is the shocking math the comparative method forces you to confront. If you stop at the $189 million common price, you think that's your total equity cost. But those warrants are integral to the package. They represent future claims on the same earnings and assets you think you're buying today.
So the effective equity value isn't $189 million at all.
No, it's the sum of the common shares, 189M, plus the market value of those dilution instruments, 221M. That totals roughly $410 million.
$410 million. And that's just the equity and potential equity claims, right? Before debt or preferreds.
Exactly. If we then conservatively add, say, $121 million of senior securities debt and preferred stock on top of that effective equity value, your total capitalization, the real price to own the whole enterprise and satisfy all claims, climbs to over $530 million.
Okay, $530 million total enterprise value. Now let's bring in the income to get the PE. Suppose net income available to common shareholders was $6 million last year.
Right. So based purely on the quoted common price of $189 million and that $6 million income, your PCE looks like roughly 31 times high, but maybe justifiable in some contexts.
But based on the effective equity value of $410 million.
Now you divide $410 million by $6 million income. The PE ratio you are truly paying, the one that accurately reflects all outstanding equity claims, is 68 times.
68
Well,
times. That's
yeah.
astronomical. It goes from a steep 31x to a totally indefensible 68x just by doing the proper capital structure math.
The 31x quote is a complete mirage.
It really highlights why you must treat warrants and converts as full-fledged equity claims, not footnotes.
Absolutely. When you buy common stock in a complex company, you're not buying a sealed box. You're buying a box with IOUs for future shares already taped to the lid. You have to count those IOUs and add their market cost to your total price.
I think this might be the single most important technical takeaway from all 8 pairs. That jump from 31x to 68x. That's often the difference between making money and permanent capital loss.
It really is. So here's a reliable shortcut for your process. Whenever a company has sizable warrants or converts, calculate both the quoted PE and the effective PE.
Okay.
If the spread between those two numbers is larger than, say, 25%, and the underlying business isn't some incredible reinvestment machine generating massive cash flow, which this conglomerate wasn't, you almost certainly have a fatal mispricing of risk. Proceed with extreme caution, or maybe just move on. Okay, our final pair. Pair 8 often forces investors to confront the market's irrationality head-on. It really tests your patience, even if you're disciplined.
How so? What's the contrast here?
You had Company A, a steady, maybe even boring workhorse. Decades of consistent dividend payments, a clean, pristine balance sheet, earnings that just steadily marched upward year after year.
Sounds like a dream investment.
You'd think so. Then you had Company B, its neighbor. This one was a serial dabbler, constantly jumping into tiny, speculative new ventures, paid absolutely no dividend, and quickly recorded an operating loss after one of its experiments failed.
Okay, so A sounds great, B sounds terrible. What's the punchline?
The punchline is that at one point in the market cycle, this serial dabbler, Company B, commanded a higher aggregate market value than the steady dividend workhorse, Company A.
Seriously. The loss-making no-dividend dabbler was worth more than the consistent dividend pair.
That's what the market decided for a time.
Wow. So the conclusion here isn't exactly encouraging about market rationality.
It's not cynical, though. It's foundational. The market isn't a machine processing facts. It's a human crowd, driven by emotion. And therefore, you must build extreme patience into your investment process.
Because the market can stay irrational longer than, well,
Exactly. For extended periods, the market will inevitably pay a significant, often unjustified, premium for novelty, for the promise of the next big thing, and it will often completely neglect dependable sturdiness and verified cash flow.
So your job as the patient owner is to be ready when that sturdiness gets mispriced.
Precisely. And the opportunity becomes particularly attractive when the price of that sturdy operator approaches its net working capital value, especially if that's combined with a long, consistent dividend history.
That dividend history being the clearest signal of prudent management.
It's a very strong signal, but we also have to be realistic. Even the reliable company, the dividend workhorse, isn't immune to cycles.
Right. No stock goes up in a straight line.
In the source material, even the workhorse saw its earnings slow and its stock price get cut in half during a particularly nasty recession. That volatility is just part of the deal. Good securities get drastically cheap for reasons totally unrelated to their long-term value, usually just panic and macro fear.
Which is why that pre-commitment we talk about is so vital. You need your shopping list ready before the panic hits.
Your thesis written, your sizing rules fixed. You have to be ready to act with conviction when fear is highest, and that reliable company is selling at an irrational discount.
So the action rule from this pair boils down to a simple owner's question.
Yeah. When you see a sturdy, dependable operator selling near its net working capital, NCAV, ask yourself, if I could buy the whole company, all the cash and receivables, minus all current liabilities for the current market cap, would I do it?
And if the answer is a clear yes, and the underlying business is solid,
then you size the position appropriately and you wait. You've got massive room for error if you're wrong and powerful compounding potential if you're right.
Okay, so looking back over all 8 pairs from that promotional real estate trust, all the way to the undervalued dividend workhorse, there's a clear pattern, isn't there?
There really is. Markets just relentlessly alternate between these long periods of overspeculation where people pay way too much for optimistic stories,
In shorter, sharper periods of underspeculation, where they systematically neglect solid, verifiable cash generators.
and both extremes create the bedrock for profound opportunities, but only, and this is the key, only if you stay absolutely anchored on quantifiable value, real cash generation, and the true all-in price you actually pay.
The classic literature wraps this up with a necessary warning and a clear charge for investors.
Okay, what's the warning?
The warning is simple. Expect large swings. It's normal from one year to the next to see what they call 3-to-2 moves, advances, or declines of 50% in individual stocks, even quality ones.
You have to build your temperament to handle that. Volatility is just inherent in owning pieces of businesses.
Exactly. And the charge.
The charge is to build your analytical craft, your process, around finding that minority of cases where you can judge with high confidence that the current market price sits well below your calculated intrinsic value.
Which requires really reading financial statements deeply.
Simplifying those complex capital structures we talked about.
And insisting on a price that lets time and reinvestment work powerfully for you, not against you.
If you really turn this comparative method into a habit, bear markets suddenly transform from something scary into, well, gift givers, opportunities.
And that leads us to that critical inversion of perspective you mentioned earlier about quality.
Right. Quality is a test you apply. It's not some magic talisman that protects you. A high-quality business, no matter how great its margins or growth, if you buy it at a low-quality, exorbitant price, it inevitably becomes a low-quality investment.
Conversely, a merely good, dependable business like the mill or the dividend workhorse, if you buy it at an excellent conservative price, can often produce truly excellent long-term results.
Understanding that inversion where your process, your price discipline triumphs over just admiring the operation, that's where disciplined, fundamentals-minded investors really gain their structural edge.
You mentioned volatility being inherent. The historical evidence from these pairs really drives that home, doesn't it? That publisher crashing from $50 down to $10, the steady workhorse still getting cut in half.
Yeah, it documents that significant year-to-year swings are just inevitable. And that volatility, it isn't a sign your investment thesis failed. It's simply the cost of owning a claim on a real business operating through a full economic cycle.
So your strategy can't be to eliminate volatility that's impossible.
Right. It has to be to prepare for it. Thoroughly, structurally, and maybe most importantly, psychologically.
And that preparation needs to be embedded in 3 specific areas, you said.
Yeah, 3 crucial areas. First, balance sheets. You absolutely must structure your holdings to own companies that can comfortably fund themselves through a deep multi-year downturn without needing to tap external capital markets when they're likely frozen or expensive.
Like that simple appliance maker with the clean structure.
Exactly, that's the ideal. Second, preparation lies in the price you pay.
The margin of safety.
If you rigorously insist on a meaningful margin of safety at your entry point, then a 30% or even 40% mark-to-market drawdown becomes tolerable. Maybe even welcome if you have dry powder, because your original entry price already anticipated and discounted that possibility.
You bought at 10x earnings knowing it might hit 6x in a recession, but confident the value is really 12x or 15x long-term.
Precisely. And third, and this is arguably the toughest, is psychology.
The mental game.
You have to expect drawdowns as a normal recurring feature of owning stocks. You need to name the number now. What percentage loss would really test your conviction? 40%, 50%. Name it. And then pre-commit, maybe even in writing, to how you will behave before you ever buy the stock.
That pre-commitment acts like a moat around your temperament when the market's panicking and the headlines are screaming disaster.
It's invaluable. So when a stock you bought at $10 drops to $6, but your conservative estimate of intrinsic value is still, say, $12 to $18, and the core reasons you bought it are still intact, that temporary 40% paper loss isn't really a loss of value.
It's an invitation.
It's an active invitation to add to your position, assuming your sizing rules allow it. Volatility is literally the price you pay for the opportunity to buy things cheap sometimes.
And it affects everyone, right? Glamour stocks and boring stocks.
Absolutely. Remember, the glamour publisher fell catastrophically. The simple industrial also fell significantly. The difference was the industrial recovered first and faster because it wasn't burdened by crazy expectations or a complex debt structure. Your goal is to be that patient steward who buys well and holds with deep, pre-committed understanding.
Okay, let's bring all these lessons together now. Synthesize them from the 8 pairs into that simple, owner-centric checklist you mentioned for doing side-by-side comparisons. The PAIR checklist.
Right. PAIR, P-A-I-R, profile, assets, income, and relative price.
Okay, let's break it down. P is for profile and policy. What are we investigating here?
This is about management's operational discipline and communication. First, has the company stayed within its core circle of competence? Or are they chasing fads?
Are expansions consistent with the core economics or just publicity stunts?
Exactly. And critically, is their dividend and reinvestment policy actually coherent with the returns the company earns on its capital Are they reinvesting wisely or just empire building?
And the communication aspect.
Does management use plain, honest language? Or do they rely on opaque jargon and buzzwords that kind of obscure reality? Remember, the promotional firm often uses complex language to make simple things sound fancy. The prudent firm makes complex things sound simple.
Good point. Okay, A is for assets and accounting. What's the goal here?
The goal is to pierce the corporate veil, find those hidden claims. First, you must compare tangible book value directly to market value. Quantify the error, the goodwill premium you're paying.
And to deal with all the claims, right? Warrants, converts.
Identify all of them, warrants, converts, preferreds, and meticulously treat them as part of the common equity package when calculating your true price, just like we did in the dilution math example. Don't skip that step.
What else under assets and accounting?
Look for soft accounting signals on the balance sheet and income statement. Are inventories bulging? Are receivables spiking and maybe not getting collected? Are they capitalizing costs aggressively to flatter earnings?
And always read the auditor's report.
Always read the auditor's opinion and the footnotes. Look for those emphasis of matter paragraphs or any scoop limitations. They often signal aggressive or even desperate accounting.
Okay, moving on. IL is for income and interest. What's key here?
Normalization is key. You need to figure out the company's mid-cycle profitability. What's a sustainable profit margin as a % of sales and equity? Ignore the current market mood, whether it's euphoric or depressed.
And test the coverage.
Definitely. How many times does the operating income comfortably cover the required interest payments? Is there a buffer?
Track stability too, right? How did earnings hold up in the last downturn?
Crucial. Did they dip 10% or did they fall 90%? That tells you a lot about the business resilience. And finally, translate those market multiples PE, PB into an owner's yield. Then ask yourself very clearly, what specific verifiable growth rate is required just to justify today's price?
And if that required growth rate looks heroic?
The price is probably too high.
Makes sense. And finally, R is for relative price. This is where it all comes together.
Exactly. This is the culmination. Write down the key ratios, PE, PB, maybe free cash flow yield, for each enabler you're comparing side by side.
Then ask the direct question.
Ask yourself directly, which one of these two businesses gives me a fair, acceptable return without needing heroic performance or aggressive multiple expansion? Which one has reality priced in?
And demand that margin of safety.
You must. If perfect execution and smooth sailing are required just for you to break even, the price is wrong, period, regardless of how great the business looks.
And finally, size your positions based on confidence in the downside protection, not just the allure of the story.
Precisely. Size based on the margin of safety, not the seduction of the growth narrative or the headline momentum.
Using this PR framework consistently, it really slows down your decision-making in the best way, doesn't it?
It does. That habit of side-by-side comparison, it compounds over time into a really powerful temperament edge. It keeps you calm and objective when others are agitated, and inherently skeptical when the crowd gets credulous.
Okay, let's dedicate some time now to walk through a complete owner's underwrite. We'll mirror that Meteor versus Mill contrast from pair 4, using the specific round numbers provided in the source text. Let's really see the math of patience versus the math of exuberance play out.
Great idea. This makes it tangible.
Let's start with Company A, the Meteor tax prep. Stock price is $55 a share. There are 5.4 million shares out, giving it a market cap of roughly $300 million.
Okay, $300 million market cap. Now, the assets.
Right. Tangible book value is only $1.90 per share. That totals just $10 million in hard assets for the whole company.
$10 million assets supporting a $300 million market cap. Wow.
Yeah. Earnings per share are $2.51. Dividend is small, $1.24. This thing is priced entirely on future expansion and sentiment, not current reality.
Okay, now let's look at the durable one. Company B, the mill workwear. Price is $49.75 per share. Fewer shares out, 1.8 million, giving it a much smaller market cap of around $90 million.
$90 million market cap. And the assets.
Tangible book value here is $34.50 per share. That totals about $62 million in hard assets.
So $62 million in hard assets for Company B versus $10 million for Company A, even though Company A's market cap is over 3 times bigger.
Exactly. And look at the earnings and dividend for B. EPS is $4.47. Dividend is $1.80.
But let's translate this into owner's yield, focusing on what we get today before any growth. Company A earns $2.51 on a $55 price. That's a base yield under 1%. Abysmal.
Terrible starting point. Now, Company B, It earns $4.47 on a $49.75 price. That yields just under 9%.
Under 1% versus almost 9%. The contrast is just staggering.
It really is. Now, let's be conservative. Assume both can grow EPS maybe 5–7% over time, which is probably generous for Company A at that size and valuation. Company B starts with a base yield that's 9 times fatter.
So the burden of proof for Company A to generate a good return is immense. It needs massive multiple expansion and flawless execution.
While Company B just needs to be competently managed to likely deliver a decent return from that starting point.
We should also check the balance sheet risk, right?
Yes, definitely. Company B's substantial working capital was mentioned as roughly equaling its total debt, so temporary profit dips don't threaten its survival or its dividend.
Whereas Company A, with its tiny asset base, its survival depends heavily on market sentiment staying positive and that aggressive expansion continuing without a hitch. That's a fragile position.
Very fragile. Now, the stress test. This is essential. Let's simulate a serious recession, chopping 30% off both companies' normalized earnings. What happens to Company A?
Company A's EPS drops from 51 cents to maybe 36 cents. If it maintains anything close to its original crazy high multiple, the stock could easily get cut in half from $55. That's potential permanent capital loss.
Okay, now Company B, its EPS drops 30% from $4.47 down to about $3.13.
Even if we value that $3.13 conservatively, say at 10 times mid-cycle earnings, the owner is still looking at a value around $31, maybe $35. Not great compared to the $49 cost, but not a disaster. And the $1.80 dividend is likely still getting paid, carrying the position through the tough patch.
As a capital allocator, the choice of which underwrite you prefer, the one requiring perfection or the one embedding safety, it becomes pretty obvious when you lay it out like this.
Yeah. It leads to a clear action rule for pricing, doesn't it?
It does. Always prefer the business where the base yield plus modest achievable growth clears your required return hurdle without needing multiple expansion or narrative triumphs. And rigorously avoid businesses where continuous re-rating or constant flawless execution is needed just to break even.
Okay, great example. Let's do some quick practice rips now, just to really internalize how that PR framework applies to the patterns we've seen across all 8 pairs. Ready?
Let's do it. Fire away.
Scenario 1. You find the software services roll-up. Trades at 18 times earnings. Okay, not crazy cheap, but maybe reasonable for software.
Right.
But its tangible book value is only 112th of the market cap, and the footnotes reveal 3 outstanding warrant series. What's your mandatory next step using Principal A assets and accounting?
Okay, mandatory next step. Warrants. You absolutely must treat those warrants as full equity claims. Estimate the effective market value, including the warrants, then recalculate the PE and PB on that true inflated basis.
And if the new ratios still look high?
If the new PE is still implying perfection needed, say, it jumps to over 30x or 40x in this sector, you have to walk away or at least be extremely cautious. The combination of warrants and minimal tangible book is a huge red flag demanding deep scrutiny. The complexity itself is a warning.
Got it. Okay, scenario 2. You find sleepy regional manufacturer. It trades at 0.9 times book value, 8 times its 5-year average earnings. It's paid a dividend consistently for 40 years. And get this, its net current assets cover 90% of its entire market cap. What's your base case assessment using Principal R relative price?
This sounds like the quantity of value play. The base case here, assuming the underlying business quality is decent, is that you're likely getting an owner's return without demanding any heroics. You've got huge downside protection from the net current assets and the low PB.
So the upside comes from
The base yield plus potential re-rating if the market ever recognizes the sturdiness. You're essentially being paid through that low valuation and maybe the dividend to exercise patience. You're not paying a premium for perfection.
Makes sense. Okay, scenario 3. You're comparing 2 medical device names. One trades at 55 times earnings, the other at 12 times. The expensive one has fantastic margins. Everyone loves it.
Yep.
How do you actively avoid the Goodwill trap using Principal A?
Right. The 55x PE screams potential Goodwill issues. You have to immediately model it out. How many years of continued above-trend growth would be required just to earn back the massive Goodwill implied by that 55x price?
And stress test those margins.
Exactly. Stress test those fantastic margins. What happens if a competitor arrives or a key patent expires? If the bar for success looks heroically high, like needing 20 years of absolute flawlessness, you have to just admire the great business and pass on the stock at that price.
Okay, scenario 4. Publishing stocks are hot again. It's a mania. The stock you're looking at trades at 35 times shrinking earnings and 8 times tangible equity. What's your immediate action based on principal I own, income, and maybe P profile?
Immediate action. Step away from the hype. That combination, high multiple, low tangible equity, and shrinking earnings, is a terminal diagnosis for a mature company's stock price.
What else did you check?
Pull a decade of cash flow statements. See if the cash conversion cycle is getting worse. Is capital intensity rising just to tread water or support promotional efforts? If so, that 35x multiple is pure wishful thinking. You have to respect the experience embedded in the historical numbers over the current hope.
Last one, scenario 5. You find a simple company trading near its net current asset value. NCAV. Looks cheap. But you realize the business is highly cyclical, meaning those current assets could shrink fast in a recession. How do you avoid this being a value trap where the assets melt before you realize them?
The NCAV cyclical trap. This is the acid test of durability. Cheap isn't enough here. You need two key filters: governance, principal P, and competitive position.
How do those help?
If management is demonstrably aligned with shareholders and has proven they can maintain or even gain market share during prior downturns, then that balance sheet buffer might buy you the time needed for value to be recognized.
But if governance is weak or they're losing share,
then that NCAV can melt away shockingly fast. So remember, cheap is not enough. Cheap and durable is what you need for NCAV plays, especially cyclical ones.
yeah, looking back over all 8 of these pairs, it really strikes me that none of the analysis required some kind of super genius level math. It was mostly basic, reliable arithmetic.
Absolutely. What these situations demanded wasn't a high IQ, it was temperament. It was having the calm conviction to consistently ask, okay, what precisely am I paying for here in tangible assets and real earning power?
While the rest of the crowd is just asking, what's going up fastest right now?
Exactly. You need the patience to deliberately position yourself early based on intrinsic value and late relative to market fashion. And you need the humility to diversify, recognizing that even the best analysis can sometimes run into just plain bad luck, a pandemic, a sudden regulatory shift. Your process has to insulate you from those temporary outcomes.
And process really is the ultimate solution to managing those behavioral risks, isn't it?
It truly is, which is why we strongly recommend keeping a dedicated comparison journal. It sounds simple, maybe even tedious, but it's powerful.
How should you structure it?
For every pair of companies you seriously study, just jot down 3 lines. Business quality, briefly, financial strength, key points like debt, warrants, and the current price valuation. Then critically circle which of those 3 factors ultimately broke the tie and drove your final buy, sell, or hold decision.
And over time, that journal starts to reveal your own patterns.
Exactly. It explicitly exposes your own specific behavioral biases. Maybe you realize you consistently fall for glamour names. Or maybe you find you pass too often on high-quality assets just because they're only fairly priced, not screamingly cheap, costing you good compounding opportunities.
That kind of self-knowledge, seeing your own weaknesses in black and white, that's a genuine superpower in long-term investing.
It really is. So we'd encourage everyone listening, try the simple 1-week practice plan derived from these lessons.
What does that involve?
Pick 2 neighbors on any stock list you follow. Fill out the payer checklist for both. Compute the true PEs and PBs, accounting for any warrants or converts. Write just a 1-paragraph owner's underwrite for each. Decide which, if any, you'd prefer to own at today's prices.
And then the most important part.
Review your decisions 6 months later. See where your initial assessment held up and where maybe temperament or a flawed process led you astray. That feedback loop is invaluable.
You've just spent this time rigorously practicing the essential art of comparing neighbors, seeing through the labels to the economics, piercing headline EPS to understand the real capital structure, ignoring popularity to focus only on the price paid.
And that is the true heart of disciplined, long-term investing.
Thanks for joining us at Capital Allocation Lab, where the mission is simple. Revisit the classics, explain them clearly, and turn enduring principles into better decisions today.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.